picture yourself at 65, finally clocking out for the last time, sipping coffee on a porch you actually own. For most of Gen Z, that picture is quietly slipping out of reach. And it is not because you are lazy, or addicted to lattes, or bad at budgeting. The math under your feet simply changed. So let's actually run the numbers, find out what broke, and figure out what still works. Because there is a way through this. First, you have to understand the deal your grandparents were handed. Retirement used to rest on 3 sturdy legs. Leg 1 was the pension. You worked for one company for decades, and in return they paid you a guaranteed check for life. Leg 2 was your own savings. Steady wages, cheap living costs, and a paid-off house gave people room to set money aside. Leg 3 was Social Security, a government check funded by today's workers waiting for you at the finish line. 3 legs: pension, savings, Social Security. Together, they held a comfortable retirement steady. Now watch what happened to each one. Start with the pension, because it is almost gone. In 1980, most private workers had one. Today, almost none do. Back then, more than 60% of private sector workers had a pension. Today, it is roughly 10% and shrinking. Companies quietly swapped the guaranteed pension for the 401k. The risk slid off their shoulders and landed squarely on yours. A pension promised you a check no matter what. A 401k promises you nothing except whatever you manage to save and grow yourself. Now the second leg, your own savings. This is where stagnant wages collide head-on with the soaring cost of everything. Since the 1970s, worker productivity climbed dramatically, but the typical paycheck, adjusted for inflation, barely moved. So you are not earning much more in real terms than a worker did 50 years ago. But here is the brutal twist. While your wages stalled, the price of the things that actually build wealth went absolutely vertical. Welcome to asset inflation. Stocks, homes, land. The assets that quietly grow your money have raced far ahead of what the average paycheck can chase. Housing is the clearest wound. In the 1980s, a typical home cost about 3 times a yearly salary. Today, in many cities, that same kind of home costs closer to 7 or 8 times a yearly salary. The latter lost its bottom rungs. That matters for retirement, because a paid-off home was always the quiet foundation of the savings leg. Now that foundation is delayed for years. Then pile on the debt. Many of you started adult life already carrying student loans before you earned a single full paycheck. When loan payments and rent eat your income first, saving for a future 40 years away feels almost impossible. That is the squeeze. Now the third leg, Social Security. You have probably heard it is going bankrupt. The truth is more precise and less scary. Social Security is funded by today's workers paying for today's retirees. But people are living longer, and fewer workers support each retiree. Its trust fund is projected to run short in the next decade or so. That does not mean zero checks. It likely means smaller checks. Even in the worst case, ongoing taxes would still cover roughly 3/4 of promised benefits. Strained? Yes. Vanished? No. So step back and look at the stool now. One leg gone, one leg cracked, one leg shaky. No wonder the old plan feels broken. Now let's do the part nobody enjoys but everybody needs. The actual retirement math today in plain numbers. A rough rule says you need about 25 times your yearly spending saved up to retire comfortably and live off the returns. If you spend $40,000 a year, that is roughly $1 million, a number that sounds impossible on a normal salary. Here's the catch that makes timing everything. The earlier you start, the more the real work is done by compounding, not by you. Compounding means your money earns returns, and then those returns earn returns too. Given enough time, growth quietly snowballs. Watch the power of starting early. Invest $200 a month from age 25, and by 65 you could have over $500,000. Wait until age 35 to start the very same $200 a month, and you end up with roughly half as much. 10 years cost you a fortune. That is the compounding problem facing Gen Z. Debt and high costs delay the start, and every delayed year is the most powerful year you lose. So when wages stall, assets soar, debt squeezes, and the start gets pushed back, the comfortable retirement quietly drifts further away. Now for the part that actually matters. Because plenty of people in tough situations still make it work. Let's see how. The people who make it are rarely the highest earners. They are the ones who started early and stay boringly consistent. They turned themselves from pure wage earners into owners. They bought small slices of assets and let time do the heavy lifting. So here's what actually helps starting today, even if your paycheck feels small. Step 1. Start now with whatever you can. Even $20 or $50 a month matters because you are not buying retirement. You are buying time, and time is the engine. Step 2. If your job offers a 401k match, grab it. That match is free money, an instant return no normal investment can beat. Step 3. Own assets, not just cash. Low-cost index funds let you own a tiny slice of thousands of companies at once. Cash quietly loses value to inflation every year. Assets that grow are how you climb onto the winning side of that same force. Step 4. Automate it so the choice happens once instead of every payday. Money you never see is money you never miss. And step 5. Raise your savings a little every time your income rises. Lifestyle creep is the silent killer of every retirement plan. The old three-legged stool may be broken, but a new plan built on early starts, owned assets, and time can stand just as strong. You did not break the system, and you cannot wait for someone to fix it for you, but you can quietly start winning inside it today. That is exactly what we do here. We hand you the cheat sheet to the money machine. This is Brainonomics.